and today I want to talk about the difference between standard tax deductions and itemized tax deductions. So I've got a few notes. I hope you can spend just a few minutes with me here, as most all of you are going through and doing your tax work right now. I want to shed some highlights on each one of those paths and how they work to help make your decision easier as you go forward. So let's go back to 2018 when Congress passed the Tax Cuts and Jobs Act. And what that did is it gave everybody the ability to take a standardized tax deduction when filing their returns. So instead of having to keep track of all the meticulous records throughout the year, for the majority of the tax filers, this standardized deduction would be greater than what they were receiving in itemized tax benefits anyways. So let's talk a little bit about that standardized deduction. So how much is it, you ask? Well, it all depends on how you're filing. So for example, in 2020, if you were single or married filing separately, you would receive $12,400 in a standardized deduction. If you're a head of a household filer, it's $18,650. And if you're married filing jointly, it's $24,800. So as an example, if you're a single filer, again, you can deduct $12,400 from your taxable income, and you made $100,000, you would take the $100,000 minus the $12,400, leaving you with a taxable income of $87,600. All right. Now, none of that has taken into account anything you have saved into a retirement account, like a 401k or a simple IRA. So your taxable income might even be lower yet, but you know at least you're going to get that standardized tax deduction. All right. So what are some of those advantages of taking the standardized deduction? To me, it's pretty simple. It saves you time. All right. And it might actually be a bigger deduction than what you were getting prior when you were itemizing those pieces. What are the disadvantages? Well, it encourages people not to keep real good records of their expenses throughout the year, and it might actually result in people paying more in tax if they didn't keep good records and just take the standard deduction, because they might miss out on some of those deductions that they could have gotten off of their income. And I don't know about you, but I'd much rather see you keep your income in your pocket than have to pay it out to the Internal Revenue Service. So that's the standard deduction. Now let's talk about itemized deductions and how that path would work. So in this scenario, again, let's go back to the person that makes $100,000 a year. Now you're going to be able to take off certain deductions that you've made throughout the year and potentially reduce that. All right. So if you have $15,000 worth of itemized deductions, that would allow you to have a taxable income of $85,000, less than what you would have had just taking the standard deduction. But we got to figure out what can we deduct first. So there's really about 5 categories that when you fill out your taxes, you complete a Schedule A, and these 5 items are the most commonly used. Okay. So get your paper out and write these down. The first one are medical and dental expenses. Second one are the taxes you paid. Number 3 is the interest you paid. Number 4, if you're charitable, any gifts to charities that you might have made. And number 5, not so common, but your casualty and theft losses. Okay. There are a few others, but they're very uncommon, so I won't even worry about those. It's those 5 main ones that you're going to fill out on your Schedule A to help you determine if you can itemize your deductions. So advantages to the itemized deductions are pretty simple. Number 1, it'll allow you to claim more deductions if you have them. And number 2, potentially paying less tax than what you would by just taking that standardized deduction. The disadvantages is you got to be better at record keeping. You have to make sure you're keeping track of all those expenses, as if you were ever audited, you would be responsible for proving those deductions that you took on your filing. And then number 2 is there are some restrictions, and I want to make sure I have these right. So I'm going to look at my notes here. But the deduction for state and local taxes including property taxes, is capped at $10,000. All right, so that's a little bit of a restriction there, especially if you own a lot of property. The interest on home equity loans is no longer deductible. And in fact, the interest on any mortgage, first mortgage, taken out from December of 2017 and beyond, you can only deduct the interest on the first $750,000 of that mortgage. All right, so you're a little bit limited there. And then any medical and dental expenses only count as they exceed 7.5% of your income. All right, so you have to have a lot of medical expenses for those things to occur. So those are some of the restrictions. And what I think you need to take away from this video is getting a true understanding of where you think you would be most benefited from. Do I take the standard deduction because there's no way I have enough of the itemized pieces to get more than that? Or should I be keeping accurate records and trying to take that itemized deduction at the end of the year? Either way, go to your tax preparer or somebody qualified to help you figure that piece out and make sure you're not sending too much tax money to the Internal Revenue Service. So thanks for spending some time with me. Hope you enjoyed the video. Make sure you subscribe on our YouTube channel and give us a like on Facebook as we continue to try to help people make sense of all this craziness in our financial world and help you get on track to a comfortable retirement. Have a great day. We'll be seeing you soon.